Stop what you're doing right now. China just dumped us debt to a 23-year low. 23 years, that's not just numbers, it's a wake-up call for anyone who thinks the financial system is untouchable. And if you think this only affects Wall Street suits, think again. While you're watching Netflix tonight, G7 nations are scrambling to buy gold and silver from Shanghai, panicking in real time as the dollar wobbles. If you're hearing this and thinking, I need to be prepared, hit that follow. Don't scroll past this one, because understanding these moves could be the difference between being caught off guard and staying ahead of the game. China's drastic reduction of U.S. debt holdings to a 23-year low is a development that carries enormous implications, both economically and geopolitically. To understand why this is so significant, it's important to first recognize the role China has played in U.S. debt markets over the past 2 decades. China has been one of the largest foreign holders of U.S. Treasury securities, which are essentially loans to the U.S. government. By purchasing these securities, China has helped fund America's budget deficits, while simultaneously earning interest and maintaining a stable mechanism for storing its vast foreign exchange reserves. This relationship created a mutual dependence. The U.S. relied on China's investment to keep borrowing costs low, and China relied on U.S. Treasuries as a secure place to park its money. Now that balance is shifting dramatically. When China decides to reduce its U.S. debt holdings, it signals a deliberate reassessment of risk and trust in the dollar. Reducing debt holdings can have a ripple effect on global financial markets because it changes demand dynamics for U.S. Treasuries. Lower demand can lead to higher interest rates, making borrowing more expensive for the U.S. government, which in turn can affect everything from mortgage rates to corporate loans. It also introduces uncertainty and volatility into currency markets as other countries watch and potentially adjust their own positions based on China's move. The fact that U.S. debt holdings have fallen to a 23-year low underscores the scale of this shift. It's not just a minor portfolio adjustment, it's the largest reduction in decades, reflecting broader strategic considerations. China may be seeking to diversify its reserves, protect against potential dollar devaluation, or signal its financial independence and leverage in the global economy. This move also carries geopolitical weight. It sends a message that China is willing to make bold financial decisions to assert its influence on the world stage. For the U.S., it raises questions about long-term fiscal sustainability and the resilience of the dollar as the global reserve currency. In essence, this isn't just a numbers game. It's a wake-up call about the interconnectedness of global finance and the potential consequences when one major player shifts strategy dramatically. The potential instability in U.S. bond markets and interest rates as a result of China reducing its holdings of U.S. debt is a serious concern with far-reaching implications. U.S. Treasury securities are often considered one of the safest investments in the world, and their stability underpins not just American finance, but also global markets. When a major holder like China starts offloading debt, it directly affects the demand for these bonds, which in turn impacts their price and the interest rates they yield. The bond market functions on a balance of supply and demand. When demand drops, prices fall and yields rise. Rising yields mean that borrowing costs for the U.S. government increase, which can cascade into higher interest rates for businesses and consumers, affecting everything from mortgages to corporate loans. This situation creates a fragile environment where investors may begin questioning the safety and predictability of U.S. debt, which has long been considered a cornerstone of global financial security. If uncertainty spreads, other foreign holders might start reducing their exposure as well, amplifying the effect and creating a feedback loop of volatility. Even modest reductions by one country can create significant ripples, because the U.S. Treasury market is enormous, and any disruption in its equilibrium has global consequences. The instability in the bond market also has political and economic ramifications domestically. Higher interest rates increase the cost of government borrowing, which can pressure federal budgets and lead to potential cuts in programs or increased taxation. For the private sector, it could slow investment and expansion as companies face higher costs of financing. For individual citizens, it could mean higher loan rates, more expensive mortgages, and an overall squeeze on personal finances. Beyond the financial mechanics, the psychological impact on markets is critical. Investor confidence is as important as actual figures. Even the perception of instability can trigger sell-offs, speculative behavior, and sudden market swings. China's decision to reduce U.S. debt holdings isn't just a statistical shift. It's a signal that the stability of what was, once considered the world's safest investment, is now being questioned. This has the potential to reshape global investment strategies, force adjustments in central bank policies, and create uncertainty that could affect the average person's financial life in ways that are slow to materialize but profoundly significant. The reaction of G7 nations to China's reduction of U.S. debt holdings, panic buying, gold and silver from Shanghai, highlights a growing concern about the stability of traditional financial systems and the safety of fiat currencies. Gold and silver have long been considered safe haven assets, particularly in times of economic uncertainty or currency instability. When major global powers start acquiring these metals aggressively, it signals a lack of confidence in paper currencies like the US dollar and a precautionary move to protect national reserves. The decision to purchase precious metals is not just about immediate returns. It is a strategic hedge against potential market turmoil, inflation, or sudden shifts in global financial dynamics. This surge in demand also indicates that these nations are preparing for scenarios where traditional debt instruments may lose value or become less reliable. By holding physical assets like gold and silver, governments can reduce their exposure to the risks associated with fluctuating bond markets or currency devaluation. Precious metals are historically less volatile than paper currencies and are globally recognized as stores of value, making them an ideal tool for preserving wealth in uncertain times. The choice of Shanghai as the source of these metals is notable. China is one of the largest producers and traders of gold and silver in the world, and its markets are increasingly central to global precious metals trading. G7 nations sourcing metals from Shanghai suggests a recognition of China's influence over these commodities and a pragmatic approach to ensuring access to critical assets, even amid geopolitical tensions. This move reflects a complex balancing act. These nations are wary of overexposure to the dollar while still navigating economic relationships with China. The broader implication is that global powers are shifting strategies in response to perceived vulnerabilities in the financial system. It is no longer enough to rely solely on government bonds or fiat currency reserves. By stockpiling gold and silver, G7 nations are signaling caution and attempting to mitigate risk. This behavior also has ripple effects for investors, businesses, and individuals, as it can drive up global prices for precious metals and shift market sentiment toward tangible assets over traditional financial instruments. The panic buying trend underscores a global recalibration of financial security, where trust in currencies is being questioned, and physical assets are increasingly valued as a safeguard. The global financial system's fragility is becoming increasingly evident as major powers react to China's reduction of U.S. debt holdings and the subsequent rush for precious metals. For decades, global markets operated under the assumption that U.S. Treasury securities were the safest asset in the world, underpinning the dollar's role as the dominant reserve currency. This perceived stability created a foundation for international trade, investment, and economic planning. However, when a single nation, especially one as influential as China, significantly reduces its holdings, it exposes the delicate interdependence of global finance and highlights how quickly confidence can be shaken. The world's financial system is not as invulnerable as many assumed. It relies heavily on trust predictable behavior and the stability of major economies. The fragility is compounded by the interconnectedness of modern markets. A move in one corner of the world, like China selling off U.S. debt, can instantly ripple through stock markets, bond yields, currency valuations, and commodity prices. Governments, investors, and institutions are now forced to reconsider risk management strategies, diversify assets, and hedge against uncertainties that were previously considered unlikely. The sudden spike in demand for gold and silver illustrates a reactive behavior, a flight to security that underscores the instability underlying conventional financial instruments. Moreover, this fragility is not just theoretical. It has real-world consequences for economies and individuals. Rising interest rates due to reduced bond demand can increase borrowing costs, slowing economic growth. Currency fluctuations can affect imports, exports, and inflation, directly impacting the purchasing power of everyday people. Pension funds, retirement accounts, and institutional investors who assume stability in U.S. debt and the dollar may find themselves facing unexpected challenges. The situation reveals that even well-established financial systems are susceptible to sudden shocks when trust is undermined or major players shift strategy. This fragility also has geopolitical implications. Financial markets are not merely about money. They are instruments of power. When confidence falters, nations may resort to protective measures such as stockpiling precious metals, imposing capital controls, or reevaluating trade relationships. The global financial ecosystem, while vast and complex, operates on a fragile web of expectations and trust. Any disruption, especially by influential actors, can magnify vulnerabilities and create a landscape where economic stability is no longer guaranteed, demanding constant vigilance and strategic foresight. The potential impact China's reduction in U.S. debt holdings on currency devaluation and inflationary pressures is a major concern for both global markets and everyday citizens. When a significant foreign holder of U.S. Treasuries reduces its position, it directly affects the demand for the dollar, which is the currency in which these debts are denominated. Lower demand for U.S. debt can lead to a decrease in confidence in the dollar's stability, prompting other investors and nations to reassess their holdings of U.S. currency. This can initiate a chain reaction where the dollar weakens relative to other major currencies, creating an environment ripe for currency devaluation. Currency devaluation has broad consequences. A weaker dollar makes imports more expensive, which can increase the cost of goods for consumers and businesses. It can also create inflationary pressures because as the cost of imported products rises, domestic prices may follow. Even for everyday items, this translates into higher prices at grocery stores, gas stations, and retail outlets, which can erode the purchasing power of households. Businesses that rely on imported materials may also face higher costs, potentially passing them on to consumers or reducing profit margins, affecting economic growth and job stability. The reduction in U.S. debt holdings also has implications for interest rates, which are closely tied to inflation expectations. If investors perceive increased risk in holding U.S. debt, the government may have to offer higher interest rates to attract buyers. Higher interest rates can slow economic activity as borrowing for homes, cars, and business investments becomes more expensive. This combination of currency weakness, rising inflation, and higher borrowing costs creates a delicate balancing act for policymakers who must manage growth while trying to maintain confidence in the DOL. The situation underscores how interconnected global finance is with everyday economic realities. Moves made by a foreign government, such as China, can ripple across oceans to affect ordinary citizens' savings, spending power, and long-term financial planning. It demonstrates that currency valuation and inflation are not abstract concepts. They directly influence the cost of living, the stability of investments, and the overall health of the economy. As major powers adjust their strategies, the effects can be felt in real time, reinforcing the need for awareness, preparedness, and adaptive financial planning in an increasingly volatile global landscape. China's decision to reduce its holdings of U.S. debt carries profound implications for global power dynamics, particularly in the realm of finance. For decades, the United States has held a dominant position in global economic affairs, largely due to the dollar's status as the world's primary reserve currency and the stability of its Treasury securities. This dominance allowed the U.S. to borrow at low interest rates, finance large deficits, and exert influence over international economic policies. China's move to significantly cut its U.S. debt holdings challenges the status quo, signaling that financial leverage is a tool that can be wielded strategically to influence global relationships and assert national interests. By reducing exposure to U.S. debt, China is effectively reshaping the global financial landscape. It sends a message that the world's largest creditor is diversifying its reserves and is less reliant on American financial instruments. This shift could encourage other nations to reconsider their own holdings of U.S. debt, potentially weakening the dollar's global dominance over time. Financial power has always been closely tied to geopolitical influence, and China's actions demonstrate a deliberate effort to expand its role as a key player in international economic decision-making. This strategy also highlights the interplay between finance and diplomacy. Economic moves such as offloading debt, increasing holdings of gold and silver, or investing in alternative currencies are not just financial decisions. They are statements of intent and tools for negotiating power. China's adjustment of its U.S. debt portfolio allows it to protect its own economic security while simultaneously signaling to allies and rivals that it can operate independently of the traditional financial order. The broader consequence is a potential shift in how global economic policies are shaped. If the U.S. becomes more vulnerable to financial pressure from major creditors, other countries may gain leverage in trade negotiations, strategic partnerships, and global institutions. Financial markets are not isolated from geopolitics. Shifts in debt holdings, currency management, and reserve diversification directly influence international relations. China's move illustrates that financial decisions are now as much about strategic influence and national positioning as they are about yield or return, redefining the balance of power in the 21st century and challenging long-standing assumptions about economic dominance and global leadership. The increasing demand for precious metals like gold and silver as safe haven assets reflects a growing awareness of financial risk and uncertainty in the global economy. Traditionally, investors turn to these metals during times of instability because they retain intrinsic value even when currencies fluctuate or markets become volatile. Gold and silver are finite, tangible resources, unlike paper currencies, which can be influenced by inflation, debt policies, or political decisions. This inherent stability makes them a reliable store of LTH, especially when confidence in fiat money, like the US dollar, is shaken by major events such as China reducing its US debt holdings. When governments and large institutions begin buying gold and silver aggressively, it signals a shift in strategy from reliance on traditional financial instruments to tangible assets. The behavior of G7 nations purchasing these metals from Shanghai underscores the seriousness of the perceived threat to currency stability and highlights the metal's role as a hedge against economic turmoil. Unlike stocks or bonds, which can lose value quickly under market stress, gold and silver provide a sense of security and predictability. They serve not only as a financial buffer, but also as a symbol of long-term planning and risk management in an uncertain environment for individual investors and the public. This trend demonstrates the importance of diversification. While holding cash or bonds has been considered safe for decades, shifts in global debt holdings and currency confidence reveal that these instruments are vulnerable to geopolitical and economic pressures. By including precious metals in their portfolios, investors can protect their wealth from volatility, inflation, and sudden changes in financial policy. Moreover, the rising interest in gold and silver reflects a broader psychological effect on markets. When influential nations visibly purchase these metals, it can trigger increased demand globally, pushing prices higher and encouraging private investors to follow suit. This creates a feedback loop where the perceived scarcity and value of these metals grow, further reinforcing their role as safe haven assets. Ultimately, the trend toward gold and silver illustrates how crises or perceived vulnerabilities in the financial system drive a return to tangible, historically reliable stores of value, reshaping investment priorities and influencing global economic behavior. The impact of China's reduction of U.S. debt holdings on everyday citizens is significant. even though it may not appear immediately obvious. When a major foreign holder like China decides to offload U.S. Treasuries, it influences interest rates, inflation, and the overall stability of the dollar. These macroeconomic shifts trickle down to affect ordinary people's financial lives in multiple ways. For instance, higher U.S. borrowing costs can translate into rising mortgage rates, more expensive car loans, and higher interest on credit cards. Even small increases in these rates can affect household budgets, forcing families to reconsider spending, saving, and investment decisions. Inflation is another area where the effects become tangible. Reduced confidence in the dollar can lead to its depreciation, which raises the cost of imported goods. This is felt directly at grocery stores, gas stations, and in the prices of electronics or clothing. The cost of living can rise without any corresponding increase in wages, squeezing household finances and forcing people to make difficult choices about essential and discretionary spending. Over time, even retirement savings and investment portfolios can be CTD'd as the value of cash holdings and fixed income investments may decrease relative to other assets. The situation also illustrates the vulnerability of financial systems that most people take for granted. U.S. Treasuries are widely regarded as the safest investment, underpinning not only government financing, but also the structure of global banking and international trade. When confidence in these securities wavers, the ripple effects are widespread. Pension funds, insurance companies, and investment firms may adjust their strategies, which indirectly affects millions of individuals who rely on these institutions for their financial security. Moreover, the shift highlights the importance of financial awareness and proactive planning. Citizens who diversify their investments, understand inflation risk, and monitor global financial trends are better positioned to navigate uncertainty. This is not about reacting to panic, but about recognizing the interconnectedness of global finance and personal finance. When major powers make strategic moves that alter the balance of economic stability, the consequences are felt far beyond boardrooms, impacting the daily lives of ordinary people in ways that demand vigilance, informed decision-making, and adaptive financial strategies to maintain security and resilience.